Hey, how you doing? This is Stephen Williams with the CreditRepairShop.com coming to you with another video. If you're looking to get an auto loan, mortgage, or commercial loan, you need to watch this video. If you're looking to get an auto loan, mortgage, or commercial loan, you need to watch this video. And also, you better have your three C's in check. And in this video, I'm going to go over what the three C's are. You need to have your three C's in order or your three C's in check. And I'm going to go into detail about what the three C's are. So if you're looking to get an auto loan, mortgage, or commercial loan, you better have your three C's in check. And this is Stephen Williams with the CreditRepairShop.com. And we are about to get right into it. So let's start. The three C's. So, what are the three C's? The three C's are collateral, capacity, and character. Let's break them down. And we're going to do them by each here. The first one that we're going to go with is auto loan because they qualify you different depending on what type of loan that you're going for. So, when you're going for an auto loan, the first thing that they're going to look at is they're going to look at the collateral of what you're purchasing. So, they're not going to let you get a car a car loan for 25,000 if you bring in a car that's only worth 20,000. They would make you pay the $5,000 difference, or they would just say that they don't even want to uh, 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 put a loan on that car, to put a lien as the lender on that car because of the value amount. So you have to understand that. And then also the capacity. Returning visitor. The capacity means your capacity to repay the loan. Now, when it comes to car loans, the standard is very low because they're mainly, what I call it, is just playing a numbers game when it comes to auto loans. Some of them that I've seen from customers, I don't even see how they were able to get the loan because it seems like the car dealer was actually setting them up to fail when they gave them a loan. But when it all comes down to it, they're going to look at some way that they could figure by looking at your situation that you can repay the loan. Now, how do they do that? They do that with the last three, which is your character, which is your credit history. But one big, huge benefit that car dealers have when it comes to showing your credit reports is that they can pick one bureau. And some of the times they have a choice. Some of the times car dealers only use one bureau. So they might use TransUnion, Equifax, or Experian. And they don't have to use all three to get you qualified to shop your loan to any of the banks. They just basically have to use one of the three. So basically what a car dealer is going to do is they're going to try to, number one, make sure that the collateral is okay for what you're trying to get, that the car value matches the Blue Book value or the resale value from a dealer, so the bank will be okay with that. Then your capacity to repay, they're going to basically look at your credit history. If you have a bad credit history, they're going to look at if things were resolved or you filed bankruptcy or whatever. They basically want to prove to the bank that you have some type of ability to repay, and they're going to try to work with you on a monthly payment. That's why really what car dealers do is they really sell people on monthly payments, because that's what's going to get the bank to go ahead and approve it. Now, let's move down and let's move into residential loans. Now, your house, that's why I put that there, your house. This is a baseline. Obviously, every company has a little bit of variation when it comes to approving a residential loan, but it's still, we had the three C's. Appraised value of the house that you're looking at buying. No mortgage company is going to put a mortgage on a house that does not appraise out in value. If they do, they will have you put a down payment down to secure that it's down to the value that they loan out. They might even make you go put more down so they're not 100% into the house. So just an example, say you got a house that's 250,000. they're going to want the house to be appraised for that, and then most of them are going to want you to put 10% down. That's 10% down. Sorry about that. 10% down. The next thing that they're going to do that's a little bit different than what happened is that they're going to, number one, they're going to look at your ability to repay the mortgage, but what they're going to do is they're going to use a different method where they only want you to at max go 40 to 45% debt to income ratio, and what they're going to do is actually put that into the house too. So when you have your mortgage and your all of your expenses that you're paying, that's showing on your credit reports, and they might even allocate for some other things. They don't want you to be more than 45% because they know from experience from the 2008 crash, people had good credit, but they didn't really have enough income to afford the houses. So what they're going to do is they're going to figure out your taxes. They're going to figure out everything that you have to pay, and they want you to be below that level to qualify you. Now, again, there's other lenders that might give you a sky high interest rate or a trap or predatory mortgage, get you into a house or a situation that you can't afford, get you into an adjustable rate mortgage or a short-term 3 to 5 year ARM, which these things are what I call house killers. They will have you out of your house, especially if you run into any financial problems. But so they're going to want all of your payments. They want your payments to only be 45% of your income per month. And then also, they're going to look at your job history, because that's a little bit, they can kind of look at that to see the stability of your household. Now, how do they find out about your job history? They're going to go and they're going to get the credit reports from all three bureaus. This time, they're going to use all three. They're going to use TransUnion, Equifax, and Experian. They use all three, and they do what's called a tri-score, which is an average to get all of, so they'll average the score. So say, for instance, you have a 700, 650, which, that could be because there's certain items that are not being reported on this one that's being reported on here. And then say you have a 675, they'll average that all out. And this isn't the exact number, but just say that it all averages out to a 680. Then what they'll do is they'll give you an interest rate based on that 680. But also, they're going to want to check public records, any tax liens, any liens or judgments that are against you. So they're going to look at with the final C, which is your character, your credit history. And again, just like I said earlier, they're going to want about 10% down. Some of them have new first-time home buyers programs, or if you're in the military, there's different programs that you can get approved for. But this is the baseline of what you're going to be facing when you go to get a mortgage. There's no getting around it. If you're looking to get a mortgage, you need to have all of this stuff resolved. So you need to make sure that you're in this range with all of your payments, your car payments, everything, and what the mortgage would be per month. And so you might as well put your light bill and stuff like that in there. And insurances, you need to be at a max of 45% debt to income ratio on your payments each month. And then they're going to make sure that you have all of these things. If you have any liens or judgments, you're going to have to take care of those first. Any public records, because they're going to look at your public records history to make sure that stuff is resolved. And then you're going to have a down payment. And really what it's doing is if you fit and get all of this stuff taken care of, it's going to make your capacity to repay a lot better. And that's what the banks are looking for. Now let's go and move to commercial real estate. A lot of people are looking at commercial real estate. I'm actually looking at a property now that we're looking at fixing up and actually moving into the top level. But so they're going to use the same thing. They're going to do the collateral appraised value of the property. And something that's a little tricky is some people think that, okay, I'm going to buy a building for $200,000, but I'm going to fix it up and it's going to be worth $300,000. the bank is not going to give you this value. They're going to go with the lowest value first. And that's a misconception. And I'm seeing some people that are out there talking about real estate investing, and they're always pointing out that if you get a loan and you're going to have that loan for the appraised value of what the property will be worth once it's fixed. The banks don't play that game because they don't want to get caught in a trap. So they're going to basically go with the lower value, and then you're going to, after you fix it, you can go and get it refinanced if you want to pull money out or something at the new appraised value. They're going to look at your capacity to repay, and you must show that you have income to pay the mortgage on the property. And some of these mortgages also, some of the terms could be 3 to 5 years. You might get a 10-year or 20-year. It's very different. So you have to look at what they do is they'll mortgage out. The mortgage payments could be more amortized as a 20-year mortgage, but the term of the loan could be 3 to 5 years or 3 to 7 years. Commercial is very different. They rarely go past 10 years to pay off a commercial property. Now, you have to show that you have the ability to repay the loan, but let me show you some ways that you can actually use the property to help with that. So before we get to that, let's look at the character. They're going to look at your bureaus. They're going to make sure that you don't have any public records, judgments, etc. But your credit rating is not necessarily what's going to be determined for you buying a commercial property. They're going to, especially if you have a business, and that's what they expect you to have, they're going to just look at your business taxes and look at the credit of your business. Even if you don't have a lot of credit for your business, that's not going to matter, because they just want to make sure that you don't have anything that's going to, have liens or anything put on top of the building that you own. Now, here's a formula that can be used on a commercial property. And also when they figure your capacity to repay, what they do is they're gonna, just say for instance you're a couple, husband and wife, they're gonna want to allocate a certain amount of income for you to be able to sustain yourself with, groceries, basic living expenses. Even though it could be more or less, each bank has their own criteria where they're going to say, no matter what you say, we are going to allocate this amount for your own personal expense. So then the next thing they're going to do is they're going to look at your debt to income ratio on payments that you're making. So let's just say, for instance, if they gave you $25,000, that they're saying out of your income that you're showing, $25,000 is automatically coming out of it, and then you have some car payments and a mortgage on your home and some other stuff, and they add up all of those payments, and that adds up another $15,000. They're going to take away from your income that you're taking out, that you have shown them on your taxes. They're going to allocate with this example, $40,000. So if you're showing that you only make $50,000 because you took a lot of write-offs, if that $10,000 does not take care of the mortgage that you would have on the property, they're not going to qualify you for the property. But there is another way that you can get qualified, and that's where, if the property is already, if it already has leases from people that are renting in the property, or if you are going to be fixing up and you're gonna have signed, you already got some people that'll sign a lease saying that they intend to rent from you. So let's just say, for instance, you have 3 units there and you're getting $1,000 a month each, so you're getting $3,000. They will allow that income to be added up on there. So if we go with $3,000 times 12, that's going to give you another $36,000 of income to go towards the payments that would be the debt service payments that would be needed to make on the commercial property. And so that's how a lot of people get into commercial properties. You got to have all your other stuff in order. You got to have a plan. You got to have the leases signed. Or if you have people that are already in there, you got to make sure that you get something signed that they intend to stay. And then this would be an excellent deal that could formulate for a commercial property. And then the last thing that you would have to qualify for, and this is so you can get very good interest rates, because again, you don't want to get into a property where you can't afford to make the debt service payments. Even if you're making a bunch, you need to allocate for things to go wrong, for vacancies, all of that stuff. So you want to make sure you get a good interest rate so you can pay that property down as quick as possible. So the next step on that is usually most banks, commercial lenders, are going to ask you to put 25% down. And if you can do that and you have all of these ducks in a row, you're going to be able to get yourself qualified for commercial property. Now, this is only a baseline. Obviously, there could be more to this, especially if you know people that are more experienced real estate investors. I have invested in real estate. I own commercial property and residential, and so I've seen how this can work out and how you can get into a property with 25% down and basically have the tenants, the businesses that are leasing from you, actually paying your mortgage down, and you can make good money with that. So I hope you've enjoyed this video. If you have any questions, please visit us at www.thecreditrepairshop.com. We're going to be doing even more videos talking about wealth in the upcoming year, 2018, because I believe that it's not just about repairing your credit. It's about positioning yourself to be able to build wealth, and that's what we're hoping to help people do. So thank you for your time and have a great day.